So this is really, really, really key, right? The idea of what is a relevant cost. Okay, in economics, we use the term marginal cost. Right, so as I keep saying, this class, managerial accounting, is really a lot of managerial economics, and this is one of the most important, these next two slides are some of the most important sort of economic concepts that apply to decision making. So we want to use relevant financial costs, which are those that are related to the future, and they are different among the alternatives that you're looking at. So, for instance, if you're looking at how to continue your college education, and you're looking at maybe, changing majors or changing colleges, the fact that you've already got 3 years of college under your belts with a management degree at Keene State doesn't matter for the future. That is not a relevant cost because it's not different from all your alternatives. If you're thinking about changing majors or changing schools, what you've done in the past doesn't matter. It's not relevant to the financial aspects of these decisions, right? So we only look at future costs and future revenues. We do not look at what are called sunk costs. This is really, really psychologically hard for people to do, but it is unequivocally the only way that you can make rational economic decisions. You have to ignore sunk costs, things that won't change no matter what decision you make. Okay. Now here's another economic concept that is in play here in our accounting class, this idea of opportunity cost. The cost of what you give up, what you forego when you choose one alternative or another. For instance, let's say that you are working landscaping, you're making $15 an hour, you have all the work that you could possibly want, or you could go to school full-time and not work landscaping. The cost of going to school full-time is the wages that you forego in addition to the tuition and whatever else it costs you. You have to look at what you're giving up as part of the cost of making one alternative or another. Right, so the thing is that accounting doesn't really have a way to do that, because financial accounting is about reporting and, specific financial accounting formats. But opportunity costs are part of our decision making, right? So again, this is one of the many ways in which managerial accounting differs from financial accounting, right? When you're looking at the cost of going to college and laying it out, in a income statement, you're not going to mention the fact that you're not making that $15 landscaping. But really, that's part of the cost of going to college, right? So these are some of the kinds of costs that we consider in decision theory that we do not necessarily consider or have a way to account for in financial accounting. So typically, I don't go through these example slides. They're wordy and they're weird, and you guys are able to read. But I want to make sure and take the time to explain this a little bit more clearly with an example. All right, so let's go through this. At the end of the semester, this girl, Allison, has to make a decision regarding whether to keep or sell the textbooks back. Okay, so she learned that she could sell these books for $25 a piece. And so she decided, right, look at this. The opportunity cost of her keeping the books, that is not selling them back to the bookstore, was $125. Right, so that's what an opportunity cost is. An opportunity cost is the cost of what you give up by making one decision. If she decides to keep the books, the opportunity cost of that is $125. So that's what opportunity cost means in this context. But what about, right, if she did sell the books, is there an opportunity cost associated with selling it? What does she give up if she doesn't keep the books? Right, so she needs to think about whether she's going to actually want to use those books during her remaining courses, right? Because there would be a potential opportunity cost of not having them anymore. So a lot of time, opportunity costs involve time and how we value our time. So, you get $125 in your pocket, and now every time you have a question about managerial accounting, you got to go on Google and figure out, what the right words are even to ask the question, right? In our little example here, she thought that her that her roommate would want to borrow the textbooks to do geographically segmented income statements. Right, so these are the kinds of opportunity costs that you incur that are harder to quantify but are no less real. And so once you start thinking about things that way, once you start thinking about the cost of your time, the cost of your effort, the cost of what you can't do if you choose one alternative versus another, right? It is incredibly empowering to learn to think about decision making in terms of opportunity costs as well. Okay, our last cost concept here in this conceptual introduction to relevant costing and short-run decision-making is, as I alluded to before, the notion of a sunk cost. A sunk cost is sunk. You can't affect it by any future action. As I said, it is very difficult psychologically to disregard sunk costs. It's just hard not to consider them. How much you've already invested in this or that or the other thing, but for business decisions, they truly are irrelevant, right? You could have invested $1 billion in some new product or new initiative, and if it's not working out, you got to decide whether how you're going to move forward. You cannot consider those sunk costs. One of the major sunk costs that managers have to deal with in their decision making, or have to, I guess, not deal with in their decision making, is the question of depreciation, which again, it's sunk. You can't do anything about your depreciation expense. It's associated with a capital investment that you made in the past, and it is determined when you first acquire that asset how it's going to be depreciated. So you just can't look at the original cost of your assets and the depreciation, because it's not going to change, right? It's not going to change between your future alternatives. Now, this is the last slide in this first very long video here, and I just wanted to briefly sort of give you a taste of things to come. These are the kinds of decisions that we're going to learn how to analyze in this chapter. You're going to look at make or buy decisions. You're going to look at keep or drop a segment or product line. You're going to look at whether you should take a special order at less than your normal price. And then this question of further processing joint products or to sell them at the split off point. So this is a little bit more sort of conceptually challenging, but we'll get there. We'll get there. So you're going to do that. And I'm telling you, this is so useful, so empowering, not just in your business life, but also in your personal life. So hang on for the ride.